Good afternoon, folks. Good evening, folks. Welcome to Marcellus's Kings of Capital webinar with Tamal Bandyopadhyay, the author of several books, but the one that we'll focus on today is Pandemonium, the great Indian banking tragedy. Banking is a subject, lending is a subject very close to our hearts in Marcellus. Tej runs our Kings of Capital portfolio. And I have to confess that, Tamal, people like us in Marcellus, we thought we knew a few things about how Indian promoters steal money from the banking system. Your book opened up a whole new dimension of thuggery and thievery in the banking system. So I'll do a more formal introduction to Tamal. He is one of the most senior journalists. I think many of you who are joining this call, and I can see the numbers rocketing, many of you, I'm sure, have read Tamal's column, Bankers Trust, for a decade now. I have to confess, when I migrated to India 12 years back, I spent the first 2 years religiously reading every column to understand how this country functions. Tamal is also the one of the founding members of the Live Mint team, the Mint team, and he was also the recipient of the, let me get this right, recipient of the Ramnath Goenka Award for excellence in journalism in 2017. Amongst other books, I mean, we're going to discuss today Tamal's super book. I mean, it's an incredibly entertaining read, Pandemonium, but he's also written probably the definitive book on HDFC Bank, A Bang for the Buck. He's also written a book on Bandhan Bank, a celebrated book on Sahara, which I think was in the news for many years for reasons that Tamal perhaps will discuss over the course of our discussion. So welcome, Tamal. Thank you for joining us.
Thank you. Thank you for calling me. Yeah.
Before we hand over the mic to Tamal for him to discuss the super book, I'll request my colleague Tej Shah to give us a view on how we see the credit quality issues panning out in the Indian banking system. Right, you would have read Tej's blogs and newsletters, but I request Tej to give a view. And folks, as the session progresses, if you have questions for Tej, for Tamal, please put them in the Q&A box. Don't use the chat box. Please put the questions in the Q&A box, and then over the course of the next hour or so, we'll try to take as many of your questions as possible. Tej, over to you.
Thank you, Saurabh. So, first, coming to where we were before COVID. Even before COVID, we are seeing multiple challenges with the banking sector as a whole. Every year there was some or the other challenge. FY16 we saw demonetization, and FY17, 2017 we saw introduction of the GST. 2018, 2019 we saw the DHFL crisis, we saw the ILFS crisis, collapse of the Yes Bank, collapse of Yes Bank, and 2020 we finally saw COVID. So actually the Indian banking sector was in dire straits even before COVID hit us. And then when COVID hit us in March, April, when there was a lockdown for a few months, we saw about a 40% correction in the bank nifty. And our thesis then was that this is a time when high quality lenders gain market share, especially post a crisis. It is the likes of HDFC Bank, Kotak Bank, etc., which gain market share, and that is when we launched the Kings of Capital portfolio. So we get a few questions. We've been getting a few questions since we launched the portfolio. And the questions are around, would we not see the Kings of Capital portfolio, the lenders in the Kings of Capital portfolio, suffer in the coming months as we see recognition of NPAs on the balance sheet of these lenders? And also, will it not, as a result of the recognition of NPAs, affect the profitability and the balance sheet strength, liquidity, Tier 1 capital, etc., of the lenders in our portfolio? So we compared our lenders to the larger industry and also to PSU lenders. What we found out was that first, the Tier 1 capital adequacy of our lenders in December 19, that is before COVID hit us, was 18% on average. And this is the first column of this table. 18.2% Tier 1 in December 19. That actually, as per the latest quarterly numbers, September 20 numbers, stands at 20%. So actually, the Tier 1 capital on average for the lenders, 8 lenders in our portfolio, has risen by 2 percentage points despite COVID. And this is after providing for about 10 to 15% of their loan book under moratorium. So despite heavy provisioning, the Tier 1 capital of the lenders in our portfolio increased by a couple of percentage points. The reason behind this is twofold. A couple of lenders in our portfolio have raised equity during the past 6-7 months. For example, Kotak's gone ahead and raised equity. And the second reason is that because these lenders have strong, resilient operating profitability and they've slowed down lending, they've become more conservative, they've been able to maintain their tier 1 and actually in some cases also improve upon their tier 1 capital. When compared the lenders in our portfolio, which cumulatively have somewhere around a 15% market share, to the top 3 PSU lenders in the country, which cumulatively have about twice the market share, 27-28% market share, we found out that the tier 1 capital of the top 3 PSU lenders is half of the Kings of Capital lenders. So tier 1 capital adequacy so for Kings of Capital lenders was around 20%. This number is at around 11% in September 20 for the top 3 lenders, top 3 PSU lenders. Similarly, we saw that 10 to 15% of the moratorium book has been provided for the KCP lenders versus that only about 2% of the moratorium book has been provided for. So in summary, about 6 times higher provisions for the Kings of Capital lenders, and despite the 6 times higher provisioning for COVID, twice the capital adequacy compared to the top 3 PSU lenders. So the way accounting is done for Indian lenders is that once NPAs are recognized depending on the best estimates of the banks and NBFCs, they provide for say 60 to 70% of those NPAs depending on what their estimate is on the recoverability of NPAs, recoverability of bad loans. Because we are seeing that NPAs are not being recognized because of multiple reasons, because of the moratorium first, because of the standstill provision then, and then finally because of the Supreme Court verdict. We are seeing that the base, that is the denominator, has become stagnant or has reduced. But the top 3-4 lenders, as an illustration we have illustrated over here, Kotak Bank, Bajaj Finance, HDFC Bank, have continued to provide for these NPAs as if they were actually being recognized. So we are seeing the provisioning and the provision coverage ratios skyrocket over the past 6 to 9 months because provisioning has actually accelerated while NPA recognition has stopped. So we're seeing that, for example, for Bajaj Finance, we're seeing that provision coverage has increased by 3 times over the past 1.5 years. Similar has gone from 100% to 200%. So it's doubled over the past 9 to 12 months. So even though NPAs are not being recognized, provisioning for these lenders continues. And therefore, we believe that as NPAs will start getting recognized as and when the Supreme Court order gets lifted, the impact on profitability will not be as much for the lenders in the Kings of Capital portfolio, because they've already provided for assuming that the NPAs would have been recognized. So the impact will be disproportionate on lenders in the Kings of Capital portfolio versus the other PSU lenders. And this is from the financial stability report of the RBI, which said that in a very severe crisis, in an extremely severely stressed scenario, we'll see that only 12 lenders will have a 14% or higher tier 1 capital. And we believe that even in such a scenario, we saw that the Kings of Capital lenders today on average have 20%, around 20% tier 1. We believe that even in such a scenario, all lenders, all Kings of Capital lenders would fall in this bucket. That is, even if we see a extremely high rise in NPAs, they'll be well capitalized to not only survive the crisis, but also gain market share through the crisis. So summarizing the impact and what we see as a result of these factors is that the 3 PSU lenders who account for 27% market share, they are likely to see a rise in provisioning as NPAs will get recognized over the next few quarters. Therefore, their profitability is likely to get impacted and their tier 1 capital will very likely deplete even further. Secondly, like we have seen over the past few years now, we'll see that private sector banks, and especially the private sector banks which are well capitalized or very well run, will continue gaining market share. over the past couple of years, we are seeing that 80% of incremental lending and about 80% of incremental deposits are going to the private sector banks. And that is why the kings of capital lenders are likely to benefit from the impact of COVID over the next few years. So this is what we launched Kings of Capital with. What we have seen over the past 4 decades in India is that there is an economic recovery in India only when the US goes into recession. So we've seen 4 times in the past 40 years India go through a period of economic recovery, and every time it has been preceded by an American recession. And the reason behind this is twofold. One is that every time the US goes into recession, the blue line on this chart, which is the American bond yield, the fall in that blue line gets accentuated even further. So if we look at this chart, if we look at 1984, 1985, if we look at 1993, 1994, similarly 2008-9, we see that the US 10-year bond yield gets the fall in the US 10-year bond yield accentuates every time there is an American recession. So that is reason number one. The second reason is the orange line on this chart, which is the crude oil price in dollars per barrel. Similar to the 10-year bond yield, there is a crash in crude oil prices as well every time the US goes into recession. So these two factors put together, cheap oil and cheap money, lead to an Indian economic revival. And therefore, we have seen with 100% correlation that there is an Indian economic recovery only when there is an American recession preceding it. And this is something similar that we are seeing this time around as well. We've seen crude oil prices crash. We've seen that the US 10-year bond yield has also fallen off over the past year or so. And therefore, we are seeing early signs of an Indian economic revival. This is our Kings of Capital portfolio performance since we launched on 28th July. Then this is in absolute terms. The King of Capital portfolio has got about 27% returns since 28th July. And this is as on 31st December. So that's it from my side. Back to you, Saurabh.
Thank you very much, Tej. So folks, I think Tej is referring to me when he says, as of 31st December, the first customer of Kings of Capital had generated 31% in 5 months. And obviously, you could argue that 5 months of returns mean nothing. But the core thesis, and the reason we invited Tamal today, the core thesis we have for Kings of Capital is we've created a situation in our country, both in the banking system and in the NBFC system, where the ongoing decimation of much of the banking system and the much of the NBFC system is basically handing over the industry. And remember, banking and financial services is India's largest industry. The ongoing decimation of the banking system and the NBFC system is handing over the largest sector in our country to a handful of companies. There are plenty of mind-blowing statistics in Tamal's book about that. I'll cite some of them in due course. But rather than my going on and on, let me hand over to Tamal Bandyopadhyay for us to tell us about Pandemonium, the great Indian banking tragedy. Over to you, sir.
Yeah, thanks, Saurabh. As I discussed, first, thank you for inviting me here. And let me talk briefly, maybe 10, 12 minutes max, and then we can have a little conversation instead of having a long monologue. This is my 6th book. And this book has a very large canvas. In the past, I have not dealt with such a large canvas. What was the provocation of the book? It's sometime in mid-October 2019. Our finance minister was talking, giving a speech, a prepared speech at Columbia University. And there, after the speech got over, it was moderated by Dr. Arvind Panagaria, our former Niti Aayog person. One person asked our finance minister, this gentleman referred to speeches which was given by Dr. Raghuram Rajan, former Reserve Bank of India governor at Brown University. And he said that Dr. Rajan has said that too much of centralization of power in India is responsible for not achieving the desired economic growth. How do you react to this, madam? On that fashion. Similarly, the wordings could be different, but this is what he meant. Our finance minister was sort of taken aback and said that, can you please repeat what was the question? And then this gentleman repeated again. And then she said, okay, here is my answer. A pretty long answer, but essentially what she says is that she has tremendous respect for Dr. Rajan. But we must remember, it is during the time when Dr. Rajan was Reserve Bank of India governor and Dr. Manmohan Singh was the prime minister. Indian banking system, she meant actually I think she had said that India's public sector banking system had the worst time ever. So that was the kind of thing. And then one of the persons in the audience on real time from US called me, and he's familiar with my writing. He follows me. We know each other. He's an Indian but based in New York. He said, Tamal, this is what just now I heard half an hour before. How do you react to it? I didn't know how to react, but I thought, why not? Let me figure out who is actually the villain, who has destroyed the Indian banking system. So that was the genesis of the book, you can say, why I got into writing this. As I said, my all previous books were primarily biography of different institutions, good, bad, great kind of thing. But here it's a pretty large canvas. And it's a pretty daunting task. So first thing I did, I reached out to all the RBI governors and asked them whether they are willing to speak to me on this. 4 of them said yes. They are Dr. Rajan himself, and then Dr. Subbarao, Dr. C. Rangarajan, who just after liberalization in mid-90s, he was the governor, and of course, Dr. Y.B. Reddy. So that's how I started. And these are not one of the segment of this book is the interview of these 4 governor. They are not email interviews; they are interaction. And actually, this book could have been, I would say, there's a multiple books between these 2 covers of this book. So I started right from the beginning. Who is responsible for this? Is it Dr. Rangarajan who actually dismantled or rather destroyed the wall between banks and development financial institutions and created universal banking in India? But our bankers never learned how to lend for project financing. They're pretty good at working capital, but beyond that, they don't know much about project financing, the risk associated with it, the monitoring, so on and so forth. So is that which is responsible? And here SBI caps played a very critical role. And there's a clear conflict of interest. It's the merchant banking arm of India's largest lender, which has about roughly 1/5 of the banking market share. And this entity actually appraises all the projects and hawk these projects for loan syndication. So once SBI is in, others are pretty cool about coming in, irrespective of their risk appetite, irrespective of their expertise. So who is responsible? Is it this? Is it the death of development financial institutions and all this? What happened in 90s and the SBI capital markets role? Is it Dr. Reddy? Because during this time, that was the golden era of Indian economy between 2006 and 8, 9% plus economic growth, 30% odd around credit growth. Was this the time that created the bubble and we had to pay the price for it later? Or is it Dr. Rangarajan? Is it Dr. Rajan? And before that, of course, I'm coming to the Rajan, but is it Subbarao? Because post Lehman, he just parachuted from finance ministry into the Reserve Bank of India as governor, and just over a week's time, Lehman collapsed, and we saw the Reserve Bank of India in consultation with finance ministry, or rather, finance ministry and Reserve Bank of India combined. They flooded the system with money. And the rate was brought to the historic low at that point of time. Of course, now it's even lower. But RBI was pretty slow in unwinding that liquidity sugar rush and raising the rates. So Bara was taking baby steps, and we had to pay price for it, double-digit inflation and record current account deficit, which Dr. Rajan had to face while coming in 2013. Or finally, is it Dr. Rajan? Because was he very aggressive in exposing the soft underbelly of Indian banking system? Someone said from RBI, it was like, driving a car and shifting from first gear to fifth gear suddenly. Did you do that? And our banks were inconvenienced, because you remember when the asset quality review came in and banks were forced to recognize their bad assets and come up clean, IBC was not there. So was RBI in a hurry to do this? So that's only one segment of the book which these four governors were asked very frank, candid questions, and they came up with their answers. But then the book is, as I said, it's multiple books within a book. Like how did you get into the mess, the war against NPA, to the how do we treat this animal called public sector banking, which the regulations are not ownership neutral here. And what, as Dr. Reddy said, that it's not ownership that's actually important, but how the owner behaves. Is the government, the majority owner, behaving the right way? Is it a business enterprise or a socio-political instrument to do things? um, and how long it can continue? Can consolidation actually be the panacea? And why is it putting in tons and tons of money, trillions of rupees, and not getting anything out of it? How long it will continue? Then it talks about the fraud, what happened, the rising incidents of fraud, and the large scale 2 billion plus fraud that affected Punjab National Bank. Before that, many others. How other banks responsible, or where does the buck stop? And also the overactivism of the investigative agencies, the CBI and CBC, how the bankers were picked up from their home and thrown into Arthur Road jail and treated like hardcore criminals. They had to squat, all the senior bankers and senior citizens, they had to use the squat latrine. Um, they did not have even a cup to have tea, even though tea was their right in that barrack. So they had to cut the water bottle and convert it into a cup and have the tea. We'll get into all this if you ask me. Let's not talk too much about it. So all these are there and more, of course. The IBC, how is it working? The insolvency code, how does it compare with the global other parts of the globe? How insolvency laws work, and how is it happening in India? Similarly, the one chapter is called Fallen Angels. I dealt with the corporate governance issues with particular reference to Yes Bank, which came on a verge of collapse and now being rehabilitated. Of course, the rehabilitation is there. I mean, in the book, it's the behind the scene stories, how it worked, and also the story of Miss Chanda Kochar, India's second largest private bank, how the board was defending her, and the bank was issuing press releases that husband brother is not a relation under the India's Companies Act, so she could get away doing things, but ultimately she could not. So what was the story behind this? And as I said, how Rana Kapoor made Yes Bank to my bank, and virtually no bank, not virtually no bank for himself. So one second. So these are the stories, and finally, of course, the story of how Reserve Bank of India has shown itself in the entire all the issues where your colleagues spoke about IL&FS crisis and DHFL 2018. So whether it's a non-banking finance crisis, whether it's a banking crisis, whether it's a cooperative banking crisis, when did you see RBI issuing a release telling us banking system is safe, your money is safe? It has never happened. I have been following the segment more than 2 decades as an author, as a reporter, and of course, close to 2 decades as a columnist. I have never seen that. Only during 2008 post-Lehman crisis, about one particular bank which has a very, very small financial relation with Lehman, but there was some misconception in the market, and it was almost a run on the bank. RBI came out with a release saying that that particular bank was safe, nothing to be worried about. But talking about the entire system, the regulator coming up with releases, regulator tweeting, and both market regulators and Reserve Bank of India coming up with releases saying that financial system is safe. We have never seen this before. So what's wrong? Is there financial sector stability also is at stake? Should Reserve Bank of India change itself? How has it done its supervision and inspection, etc., etc.? So everything is there. And finally, there's one chapter which has some 16 odd charts. And those charts actually tell the story in a far better way than this 1 lakh, close to 1,50,000 words. So if you are a reader and if you're buying the book, if you don't have time, you don't have to read everything. You just go through the chart. Those charts tell you. Just I will talk about only two charts. Uh, one chart talks about, like, traditionally you will hear people are talking about India's public sector bank is a large market share, 70%, etc., etc. It's not 70%, it's 65%, less than that. That's a story, but that's on the stock on an incremental basis. In the past few years, I think 2018 and 2019, incrementally 80% of market shares actually belong to private sector. Public sector is less than 20%. And trust you me, this is the story of deposits as well. So we talk about proxy sovereign guarantee, your money is saved. But actually, out of 100 rupees, 82 rupees are going to the private sectors, even for deposits. So this is one chart. Another chart is, if you are so serious about reviving the public sector banking, etc., etc., you keep on giving money. But do you know what you do? I have seen that there's a difference. How much time a bank, the CEO's position remains vacant. One CEO goes out, exits, and other CEO comes in. There is as much as 9 months for one particular CEO. And for Bank of Baroda, which is the first experiment of banking consolidation, 100 days. The person who was handling actually was architect of the consolidation, being the CEO. Of course, it was created in not block finance ministry, but being the CEO was implementing. After he left, the next CEO took over. In between, there was a 100 days gap. So I wish I could have actually called it, and I'm serious about it, the Great Indian Banking Comedy, not a tragedy. The book should have been. So this is what this is a book. I think final minute is this. When I decided to do the book, one way of doing it was, uh, looking at the charts and graphs and Reserve Bank of India rules, regulations, bank's balance sheet and all, and make it a sort of case study, or a lot of facts and figures. But that would have been probably boring, and I'm not capable of doing this academic exercise because I am not qualified to do this. I'm not a finance person. The other way of doing it, probably this, sitting in this small study where I'm sitting it now, and tell you that this should have done this way, that should have done this way. But I am not Raghuram, Rajan, or Y.V. Reddy or Vilar Acharya. So nobody would listen to me. Who the hell am I? So I have taken the easiest way, is telling a story. Just embellishing you with certain facts and figures which are relevant, but actually telling the story of Indian banking. Call it tragedy, call it comedy, whatever it is. So this is a bird's eye view. At the same time, it's fly on the wall kind of commentary. I tried to combine this, and going by the reader's response, I think you guys are enjoying it. Thank you. Thanks, Saurabh.
Thanks, Tamal. I think to say that we enjoyed the book is an understatement. I had one of my most enjoyable Christmases reading the book twice over. So the questions are piling up. I'll pose three, and then I'll hand over to Tej for him to pose a few more basis the Q&A box. Folks, I remind you again, please put your questions in the Q&A box. We'll sort of aggregate them and pose as many to Tamal, and we'll use his time as efficiently as we can. So Tamal, I'll start with the point you just made. So in fact, as you were talking, I was looking at page 467 of your book, where you've got a chart based on RBI data saying privatization by stealth. And what you have shown there is the steady decimation of PSU banks, right? As you mentioned a couple of minutes back, if you look at incremental loans and incremental deposits, 70-80% of the activity is moving to the private sector. And given that, I remind listeners again, we're talking about the largest sector in the Indian economy. We're talking about 35% of the Indian stock market. We are handing that over to the private sector, right? So the question then becomes, Amal, given the massive amounts of wealth, GDP at stake, is there anything that can happen in our country which stops this steady rot of the PSU banks, these vast PSU banks, which even today, as per page 469 of your book, account for 60% or 55% of loans outstanding. That they seem to be on a road to sort of Air India style ignominy. Basis your experience of banking, can anything happen which will stop the rot and stop the handover of market share from public sector banks to private sector banks?
The only way it can happen is this, which we hear could happen, if you decide to privatize it, at least some of them. So you call it privatization through backdoor or privatization by stealth. It's a matter of semantic. All of us know, but what I am pointing out, or what I pointed out in this book, is this: maybe, at least two gentlemen spoke about it openly. One is Nandan Nilekani, and another is Mr. Uday Kotak. They have given certain time frame by which private sector banks public sector banks market share would come down. But I think in reality, if we go by the numbers, it will be even faster than what Mr. Nilekani and this thing has said. It's a question of a few years when it becomes 50% or so. So it is irreversible, because apart from all the other things like your capital adequacy and quality of assets, etc., other new dimension as we speak, and post-COVID it's become very prominent, is the digitalization, the disruptions. Most of the public sector banks will not be able to handle the disruptions. They will not be able to handle the disruptions. At least two of them I know, that State Bank of India and Bank of Baroda, they are ahead of others when it comes to the digitization. Okay, but most others are nowhere close to it. So can they handle the disruptions? Apart from everything else, this is the new dimension. And again, I quote Mr. Nilekani recently. He has said that digitization is happening at a warp speed. I mean, which could have happened in years, now it's happening in weeks' time, post COVID. So this is yet another front that has opened up, which is not so good. You have to fight it out. And do our public sector entities, most of them, I don't think they have the wherewithal to fight it out. So certainly they will be, I will not call it decimated, because the government is there, my bap, so the capital will come in, etc., etc. So the only way, if you stem it, this thing, if you decide, well, keep some of them because of market failures, etc. You need to have them. So that you don't have to tell the world like what happened to Citibank. Government needed to come in post Lehman. I'm saying US. So the privatization part, it's not the everything. You have to. The state played a role. So here also, and particularly after the Yes Bank episode and the way ICICI Bank was administered and handled by the previous CEO, I think the privatization bogey also had a jolt. Kind of things. It's a little complex situations, but still, I think it's irreversible now. We need to think about it. Maybe some of them, some entities will remain. They should remain as a state instrument to prevent, as a sort of safeguard against market failures. But others, even though they are not good, I think they are great franchises. If you decide to hand them over to certain private entities, now this is a format. Whether you go for this infrastructure fund kind of thing, you ask certain funds to pull in and come in there, or you allow certain corporates who you trust. That's a separate story. But this story in the current format cannot continue, particularly again, like I said, one part is that disruption, that's COVID, and other part is the fiscal situation. Does the government have the wherewithal, the money to actually keep on pumping? So one way of actually helping the government to tackle the fiscal deficit, also generate money by selling up certain things and all. So what prevents us?
So Tamal, I don't know if you remember, I first met you 13 years ago. I went to your Mint offices. I think at that time you guys were in Dadar East, right?
Yes.
And I first met you, and one of the things you told me then, right? I was sort of all gaga about Indian private sector banks. He said, Saurabh, what are private sector banks doing in rural India in terms of inclusion and so on? And you were right, they were doing very little. I went and looked up the data. And the interesting thing is 13 years on, as you describe so graphically in your book, as PSU banks head for decimation, the entirety of tier 3, tier 4 rural India also is probably going to end up getting gobbled up by private sector banks and NBFC. So the remarkable irony in this is, without doing anything, so to speak, with regards to inclusion and rural India, banks like AU Finance are going to have that franchise, all theirs to take, because the PSU lenders who operate in the hinterland are basically going to run out of capital, as you described so graphically in your book. Let me move to a second facet of your book, which fascinated me. See, we used to think in Marcellus, we know, that the credit rating agencies the world over are conflicted. Credit rating agencies the world over are conflicted. This is not a ailment peculiar to India. In chapter 4 of your book, you absolutely shred them, right? Barring CRISIL, no other credit rating agency emerges from chapter 4 of your book with any honor. You talk about CEOs of credit rating agencies who have been taken to football matches in Spain, and God knows after that what not. You talk about their wives being given cheap flats by real estate developers in return for ratings and so on. Now, as I was reading that, I was thinking, well, this is a global affliction, and whatever be the status quo in India on this sordid topic, it's ever been thus. Why has this problem of conflicted credit rating agencies come to the fore now? Why are we suddenly beating our chest about it? It must have been like this in India 10 years ago as well. Has something changed here on the credit rating agency subject?
Yeah, thanks, Saurabh. Actually, this one I did not mention my introductory comment. Yes, there's a chapter on who will rate the rater. And yeah, credit rating model itself is, many of us think is a conflict of interest, because, I am looking to raise money and I am appointing a credit rating agency. I am getting myself rated and I have the choice whether to accept the rating and all. This is all eternal issues people to discuss. But yes, this book has showed them in a very poor light. No, it's not indiscretion. It's not inefficiency. It's plain being compromised. And if you see that at least one CEO who was thrown out by the rating agency, by the rater, when he wrote back, he did not, it's a very sentimental, long letter talking about, I have done this, I have created the organization, and essentially you have a heart, take pity on me, don't throw me out. If you really are a well-governed person and if you have been wronged, then your language would have been very different. You would have threatened with a court case, you have sent a legal notice. You have not done that. You just said that I have created. Now you have created an agency, you have created an organization, but that does not give you the license to be compromised, which is exactly has happened. Now, has it been always the case, and why has it come in the open? It has come in the. Has it been always the case? Probably my interaction with the rating agencies always feel that there is something fishy. Not everything is good always, but everything has come out because of multiple factor in 2018. Because 2018 was the post. What happened is this post Lehman, the liquidity sugar rush, and everybody and its aunt was borrowing left, right, and center, short, and lending long, and which is why I said many of them. What happened in our non-banking finance sector, where we have seen the fall of ILFS and DFHL and near fall of few, some of the analysts described it as sort of Lehman movement of India. I said no, it's not Lehman movement, it's the Northern Rock movement. It's the plain movement. Apart from many other things, is the asset liability mismatches. They all borrowed short and lent long. And 2018 was the time when then RBI governors started tightening the rates. And when the short-term rates moved up 150, 200 basis point, these fellows had nowhere to hide. So suddenly the music stopped. And all these stipulated companies overnight have because they were raising money and no question asked, and diverting money, doing everything once you should not do. I don't want to. I mean, you'll see the book. I'm not getting into all the details, and that is the sort of time they went under, and also exposed the soft underbelly of our rating agencies. They were not doing their job rightly. Had there been no fall of ILFS, had there been no fall of DFHL, had there been no near fall of few others, our rating agency would have continued. I think this is the time, because of external factors, it happened this way, and that's how the rating agencies got exposed.
So, folks, another
And
aspect.
subsequently, and sort of subsequently, we find the regulator, particularly capital market regulator now, is much more careful and coming out with rules and regulations and all. And of course, there's
Right in the street.
introspection, soul searching by the rating agencies themselves.
Absolutely. So, folks, another aspect of Tamal's book, which you'll enjoy if you like this sort of thing, is his description of what happened in DHFL and Yes Bank. So, I think page 80, 81 of the book, he describes how DHFL has an office somewhere in Mumbai where they fabricated the names of lakhs of borrowers, right? So it's one thing to say, I don't have NPAs, or you understate your NPAs. It's a different level of creativity altogether to fabricate the loan book. In reality, the money was going elsewhere. It wasn't going to these fictitious borrowers, and that was another sort of eye-opening revelation. I think, Tamal, you took that from the Grant Thornton forensic report on the DHFL affair. Let me come to my third question. I wish I had a whole evening, but I'll limit myself to three, and then I'll hand over the mic to Tej. Uh, Raghuram Rajan's given, I think, a terrific interview in your book. I think he's been very forthright about political pressure that was exerted, right, in terms of the speed at which he pushed through the asset quality review, the speed at which he was trying to get bad assets recognized, right? And you could argue that both we have lost as a country two consecutive RBI governors who were trying to do a cleanup act on asset quality in our country. Now, COVID will obviously lead to bad asset creation, right? It is but natural that small businesses will suffer in the wake of COVID. Do you reckon we'll see a repeat now of what we went through, where banks tried to hide the bad news? As you describe in the book, banks ganged up on Rajan, they came and had a go at him. You describe midnight meetings at Mint Road and so on. Are we going to see a repeat of that, but this time with Shakti Das in the hot seat, and the recognition of COVID NPAs becoming a vexed issue as the year drags on?
Well, no, Saurabh, I'm not going to. I'll not see this. The reasons I'll tell, but before that, as you rightly said, I have graphically described what what prompted RBI to take on the wage, raising the war against NPAs. Essentially, it's a graphically I have described how they did it, how the first their platform they put in place, asking for data of all the relevant accounts, and how they found that data are divergent. The same borrower is good asset on a bank's book and bad assets on the other, and that's how it started. And then the AQR, and then the pressure from various lobby groups, then the discussion with the ministry, and so on and so forth. And even within RBI, there are a lot of differences of opinion how much time should have been given to the banks because IBC was not there, so on and so forth. It's a very graphic description. They're actually running a sort of Scotland Yard within RBI, away from the public glare, not from the central bank's headquarters, but from other office,
Cuff parade, cuff parade.
of corporate office, and it's a quite a fascinating story. I learned a lot. Now, why this will not be repeated? Well, very simple fact that the bankers have learned their lessons. Bankers have seen that there is no incentive to hide. Earlier, there was incentive to hide, but now I think they have been stripped naked. They have no place to hide because what do? You tried to do this, and then you got hauled up by RBI was as a regulator forced you to come up clean. But what did the CBI and CBC do? They actually overdid things. There could be inefficiency, but inefficiency is very different. Inefficiency and incompetence is very different from being compromised. But wherever the decision gone wrong, it was presumed that you are guilty of certain wrongdoings, and which is why I have seen that one particular gentleman who came back from late night from Delhi with a finance ministry meeting, and then next morning he on his bicycle he goes to his yoga center. There is no yoga exercise on that day, but there's a bhajana he was meant to listen to, and the bhajana says that whatever comes on your way, you have to maintain your calm, you have to be dignified, you have to fight it out, etc., etc. Ironically, what happened? He came out with that from that place, buy some vegetables, and go to his house, and lo, police guys are waiting for him. He was picked up, thrown into the police custody, had to spend the night with a hardcore criminal who was arrested allegedly for killing a builder. So that's one case. Another case, very similar thing, ex-bank. That is the kind of running a banker who is in office. And this gentleman is an ex-banker who has come back from morning walk and then finds that CBI people are inside. And the raid continued till late evening. And late evening, he was told that let's come with us to our office at BKC. And then said, would you like to take your medicines? This gentleman could not get the hint. He should have taken the medicine because once he reached the place, he was told you are under arrest. Or what? He did not know. And similarly, Allahabad Bank MD and CEO, her last day, it's 4:53, 5 o'clock, her tenure ends. At the boardroom on Netaji Subhash Bose in Kolkata, his EDs, her EDs, etc., they were working on her farewell function, and she has prepared a speech, what she would talk, etc., etc. 4:53, she gets a mail from Delhi, you are sacked. So she does not go to the boardroom. She picks up her bag and leaves the office. So bankers were subjected to do this because of all these issues. Now, who will take this? Who will take this kind of anymore? They will not. Rather, they will go to other extreme. Whenever there's a doubt, don't get into any kind of thing. Just declare it as an NPA. Don't even try to do this. Don't lend. We have come to that situation. Now is a question of being whether you are prudent or you are risk averse. RBI is saying you are risk averse, government is saying risk averse, you are not giving loans. But the bankers you ask, they said, no, we are prudent. If I give you loan, because what happened is Dr. Raghuram Rajan found out in early this last decade, 2010, 11, 12, 13, all these things, most of the Indian corporations were not putting up equity on the table. They are using bank money for debt and equity. And banks were looking at the other way around. They are giving them money. Now they are being prudent, and now we are accusing them of being risk averse. So what happened? The change is bankers have seen that there is no incentive for camouflaging, for evergreening, for showing my book very good, because ultimately I will not be trusted, and if anything goes wrong, then I'll be hauled up, and then I'll be arrested, so on and so forth. Why do it? So that's one part of it. They will not repeat the same thing. They will do the other extreme. Rather, they will not give money. And second part of this, the resilience of the balance sheets is far higher now, because not only they have been capitalized, not growth capital probably, but survival capital is there. And apart from that, you look at because you do the investment and all, I don't need to tell you, look at the provision coverage ratio. It's some banks 100%, some bank 80%, so on and so forth. And so most of them, even they have made substantial provision, and even as and when the recovery happens, even if they take haircut, they will be still in the money. You get 40% haircut, you get 60 rupees, but you made 88% provisioning, so 28 rupees you get, something like that. So I think the banking system, banks balance sheets resilience is far higher than what it was in 2014-15 before the QR, and the bankers are approaching their job from a different way. So yes, they are putting up a brave front. As we speak, they say they know collection efficiency has gone up to 95, 97%. Not too many people are going and asking for restructuring, etc. Even if we take them face value, even we presume that no, things will not be as hunky-dory, as happy as they're claiming, things will be far worse than what they're claiming, but still, it can't be a repeat of what happened in the past.
Right. So, Tej, I'll hand over to you to take the Q&A forward. For those who are interested in buying the book, I think a link has been posted. It's available on Amazon, obviously, but I'll hand over to Tej to take the Q&A forward.
Sure. So one of the questions that we've got is, Tamal, your thoughts on the licenses being given to corporate houses for banking, which the RBI has started talking about.
No, well, as we speak, 15th January is the last date for the feedback. and then of course the decision will be taken. There's an RBI working group. Now, for all such issues, it's typically RBI working group actually works in the beginning and then it's taken forward. But if you have seen the kind of controversy it had created, and there are people who are mostly against it. There are people who are in favor of it. Mr. KV Kamath is one of them who says corporate India should be allowed, and whether it's Raghuram, Rajan, and Subbarao and Viralacharya, they're all against it. I think it's created a lot of noise, and so much so that after the credit policy, the post policy meeting, Reserve Bank of India governor actually disowned it. It says no, it's not an RBI's paper. It's a working group paper. But the funniest part is this, in working group, it's not every, actually majority of the members not in favor of it. So typically what happens is this: if minority, as a sort of note that, it's a sort of views of certain entities, or there should have been a dissent note, but it was not there at all. So that gives a sort of sense that was there some kind of pressure from certain quarters, why it happened, even though majority was actually against it, why did it feature there? But by saying that it's a RBI, it's not an RBI paper, it's an RBI, it's practically disowning it. RBI governor actually sent a signal that the deal is not yet closed. So we need to figure out. I think there is both pros and cons. I don't need to get into all this detail. I think the key factor is, the pros is, why it should be given is because we need strong banks, and these corporations have strength, balance sheet strength. So that's the reason why it should be. But why it is against is that these corporations most of them are responsible for the banking mess. Would you allow them to bank? Would you allow them to actually create banks? That's the thing. But the bigger and much larger question is the competence of a regulator. Can it outsmart the corporations? That's the thing. It has gone wrong in choosing Rana Kapoor. It has gone wrong in choosing Ramesh Gili. Its inspection and regulation is not exactly the way it should have been done. So does it have the strong corporations in check from not doing things from doing things which it should not do? So that's the biggest issue. I think RBI needs to be confident enough. As we speak, Reserve Bank of India yesterday started its College of Supervision, and Mr. N.S. Vishwanathan, former Deputy Governor, will be heading it as chairman. Ravi Misra, who was in charge of risk management, will be the director of this institution, so on and so forth. RBI have been trying, but unfortunately, whether it is PMC, cooperative banks, or Punjab National Bank fraud case, or Yes Bank, or even ICICI Bank, we have not seen regulators in a very proactive way. Yes, it has not allowed any institution to fail. It has come out with novel ideas and a very innovative way of sorting out things like Lakshmi Vilas Bank or Yes Bank. But when it comes to regulation, when it comes to supervision and inspection, Reserve Bank of India actually able to handle large and strong corporations as owners of bank. That's the key thing. And if you look at the RBI paper, it also gives the caveat that Reserve Bank of India must spruce up its supervision and inspection before allowing this. So even if it goes ahead, I don't think it will happen very soon.
I think we might have lost Tej. So let me just ask another question, which I see cropping up in several places, right? So the question that's being asked is that yes, the PSU banks are sort of on their way out, but beyond the elite private sector banks, right? Those are Kotaks and the other bank that you have written so much about, Tamal. Will other smaller banks, private sector banks, will other smaller banks get their moment in the sun, or will the demise of the PSU banks simply hand over the banking sector to a few giant private sector banks? Now, you've written extensively about both HDFC Bank and Bandhan Bank. What is your thinking? Will the smaller private sector banks become vibrant, profitable, sustainable entities in due course as the PSU banks slide away?
Saurabh, I think I'll tell you a cliche. This is the easy answer that India is a vast market, is an untapped market. There's a financial depression, so there's a place for everybody, so on and so forth. I wish I could tell you this, but may not be this likely. I would like to believe that now it will be a bigger play of some of the large private banks, and of course there will and only some of the smaller niche players will be, yes, they, I think from an investor's point of view, I don't think you'll regret. I would not, because I'm not in that space, but definitely if you pick the right kind of banks, it will do well, but not that every small banks will do well. I think they're still grappling, because if you look at this, some of the small private banks, they're not doing well. Even though some of the banks which are given to bankers to run them, those who have massive experience in foreign banking, etc., etc. I'm not going to the name those banks. They have not come out well, despite given a very long period, being at the helm. But these gentlemen have not been doing a great job. From an investor's point of view, I'm saying, there are reasons. There are reasons of trade unionism. There are reasons of many other things, etc., etc. So they're not doing pretty well. And if you look at the small finance banks also, I'm not very sure how many of them. No, at least certainly not all of them are doing a great job, because primarily I think the regulations, suddenly from a non-banking financial company to a bank, it's a very different turf. It's being regulated. Reserve Bank of India is very happy, as much of inspection goes and all kind of notifications go, etc., etc. They are still struggling with the regulation part, the cost of regulation, not cost in the sense of the financial cost, but I'm saying overall cost of regulation, etc. They're still grappling with this. And hand on heart, if you ask them in private, they will say probably no. I mean, we'd have been better off by being a non-banking finance company than a bank. So will but some of them will be doing extremely well, are doing pretty well. So to cut a long story short, I'm not a person who will say that because of the weakness of our public sector banks, all the small guys will have a great run on the banking turf. No, some of them will, but primarily I think it will be we will see the rise of some of the very strong, well-governed private banks.
Tej, back to you, and then I have one last question for Tamal, which I've wanted to ask him for many years, actually.
Okay. Tej?
Tej, can you hear us? I think.
Yeah, I can hear you.
Yeah.
So another question that we got was, what do you think is the solution that the government has with regards to the PSU banks? Is a long-term solution that we're left with 4-5 PSU banks in the end? Or is the solution that we privatize and then we're left with, say, 7 to 10 private sector banks? Which way would you go?
Tej, I wish I know, because government has been saying that consolidation is the right answer. And of course, they are going by theory, because it cuts the duplication of businesses. It makes you strong, because the larger you are, the scale gives you the ability for taking risks, so on and so forth. So it's all theoretically, it's all fine. They also looked at the technology sort of similarity while picking up the right kind of partners. But even on the technology, there are different versions. So look at the consolidated entities, like 2 or 3 entities are getting merged. They are on the same technology platform, but there are different versions, and those different versions, to assimilate them, it takes years. So it's not as easy as you think. And of course, theoretically, it gives you the scale gives you the ability to for risk taking, etc. And also it cuts the duplication, so on and so forth. But ultimately, as I said, Dr. Reddy said, the problem is nothing. Problem is the way the government behaves. Now, as I said in my book, there was a Tata Steel, those days it used to call Tisco ad, that we also make steel. Now, our bankers also can say we also do banking, because banking is only one of the activities. They do lots of other things, including using sweeping and swapping the floor and the pavement near the branches on the Swachh Bharat Day. I'll not be surprised if the COVID vaccination also comes from bank branches in a lighter vein, I'm saying. So here is one, you use this, it's a socio-political instrument. I mean, irrespective of whatever government is in power, that is the nature of the beast. So unless you change it, they cannot do. You cannot, I mean, it is, in some sense, all of them are treated like Air India. But the basic difference is this: Air India does not deal with money, and here they deal with my money and your money. So they should not be treated. Now, will the government? I hear the government saying that they will be. It's a hands-off policy, so on and so forth. But look at PMJDY. Look at what is the percentage of the share of PMJDY, all the new accounts. It's 90% plus coming from public sector banks. Private sector banks are not doing anything. Can the public sector banks say no to it? No. And tomorrow, on infrastructure, on everything else, if the government asks them, is the owner, they have to do it. The 3 trillion guaranteed loan. Look at the Saurabh and Tej. You look at them, how much money is coming from the public sector banks, mostly from public sector banks. The 3 trillion, the Atmanirbhar, out of this package. So it's the public sector banks. It's a socio-political instrument. Unless you treat them in a different way, not in speeches but in real term, you cannot make them. So how do you do it? It's the government thing. But we have a very strong government, and we have a very determined government, which could go for GST, which could go for demonetization, good, bad, ugly. I'm not getting into that. So I'll not be surprised if tomorrow we find that yes, it will be privatized. By the history of what this strong government has done on certain areas, you may disagree, you may not like what they have done, but because of their majority, because of their strength, because of the determination, I'll not be surprised, in fact, if tomorrow I find that some of them are being privatized. Now, consolidation again. Why UCO Bank in Kolkata is left? Why Bank of Maharashtra in Maharashtra left? Why Punjab and Sindh Bank in Delhi left? Why IOB in Chennai left? Are they strong enough? Can they be on their own? What is their future? Why are they not coming for consolidation? Or is it catering to the state sentiments that okay, sabke paas ek rehna hai, because somebody is based in Kolkata, somebody is based in Pune. It gives a sense to the state. Okay, we own a bank here. I mean that. So I don't know. I really don't know the logic of consolidation and all. To cut a long story short, the owner must change the way he behaves. This is not the way to behave. Or you privatize, you keep a few banks, as an insurance against market failure, and the rest you allow them to be picked up by others, and they have, trust you me, they have great values.
So I'll ask a question, and Tej, and then I'll hand it back to you. So Tamal, in a way, and I'll ask this question in the context of HDFC Bank, because you've written probably the 2 definitive books on HDFC Bank, right? Bank for the Buck and the version 2 story. You mentioned a couple of minutes back that your reckoning is a few strong, well-run private sector banks will get stronger still. Given the detail in which you know HDFC Bank, why is it that, given all the vicissitudes and all the drama described in your book, why is it that this bank is able to plow through it all, right? Demon, COVID, GST, and the growth engine keeps chugging out 20-21% loan book growth. What is special about the DNA of this bank, based on what you have seen in your 20 years of covering the sector?
No, this is I think, HDFC, like many others, is a child of economic liberalization, 93, 94, that's how they born and all. I think a basic difference between HDFC and others is this: here is a bank where the employees, I'm not talking about now, not today who is joining and all, but historically, actually they all have seen their work not as an employee, but as an entrepreneur. I think that's very critical. If you look at the way the other banks at that point of time worked. Say ICICI was not a new one. Culturally, there's an ICICI Institute, and I know DFI, and it's an offshoot of that. IDBI, again, there's an IDBI, DFI coming out of that, set up by them. And then there was UTI, again, is primarily State Bank of India guys doing this and all. And then there was a Ramesh Giri and Century and others and all. Not everybody survived. But HDFC, I think, got a team which is very different. And all of them saw it as an entrepreneur. So the entire thing of the stock option story and all, so make money for ourselves. And you look at these guys over a period of time, how much the individuals what they made money for the others, they created a situation where others made money in a big way, and they also made money. I think this approach of apart from other things, like it's a very non-complicated, easy banking. It's a very boring banking. It's a very doing very ordinary things, but of course with extraordinary effect. And of course, finally, the courage to disrupt itself, not allowing itself to be disrupted by other forces. That's that my second book is the digitalization, the digital journey of HDFC. Is basically it decided to disrupt itself. We will not allow it to be disrupted, because what is all this technology and other things? No, it's nothing but OTT. It's nothing but it by allowing my they will work on my structure like WhatsApp does on a telecom structure. So why would I allow them to use my structure? Rather, I would use it myself. I'll not allow them. And Mr. Puri has said in once that you get a great chef and you give him a fantastic kitchen. This kitchen has a weighing machine. Kitchen has lovely spices. Kitchen has temperature control, so on and so forth. But can he make chicken? He can't make chicken. He can't make chicken because there's no chicken there. So chicken, I have the chicken, I'm the bank, I have the customers. They are my chicken. So I don't need such a great kitchen. Yeah. Even I have a manageable kitchen. I can make great chicken curry, because I have the chickens. They don't have chicken. So allow them to ride on me, or I'll disrupt myself. That's the second book on that. But as I said, there are a lot of other. They are very different from others. But I think the key difference is banking is a liability business, not an asset business. You need to get that right. Mr. Uday Kotak also said certainly. If the other banks, you will find that most of them, they want, I'll not name them, they want a good margin, NIM, net interest margin. So what will they do? They, as usual, they are offering good price to the depositors. On top of that, they want to have good customer. They have good money from the borrowers, so they will compromise the quality of the borrowers. So they can't afford to go for AAA rated or even a AA rated, because if their cost of money is 7 or 8% and they are looking for 12%, so they can't afford to have the best of borrowers. But HDFC Bank, historically, traditionally, bring down the cost of money. And this is traditionally, I can't say, because now every hisab has gone for a toss, because your 3.35 is the reverse repo rate and you are getting short-term money as less than 3% CP, etc. That's a separate story altogether. I don't know now. But historically, its cost of money is the lowest among the banks, so that you can have a good spread and yet you can have AAA rated borrowers. So banking is primarily a liability business. I think that's the big, apart from everything else, it's a lesson from HDFC Bank. And I have heard recently, not recently, I mean, in the recent past, yes, Uday Kotak also saying the same thing. Banking is a liability business. HDFC has taken this as a liability business. HDFC Bank has disrupted itself. HDFC Bank does very ordinary things, but effect is extraordinary. And finally, the spirit is be an entrepreneur, not an employee. That's all these things make it very clear.
This is just, I think there are several questions in the Q&A box about this bank or that bank and so on and so forth. So folks, one of the lovely things about banking is you can go to the high street near your house and actually learn a lot. So I live in a place called Hiranandani Powai, and there's a massive HDFC Bank branch in the middle of Hiranandani Powai, just next to the D-Mart. And across the road, there's a branch of IDFC Capital First. You go to the HDFC Bank branch, you realize the cost of funds basically is 4.6%. You go to the IDFC Capital First branch, they're offering you fixed deposits, I think 7.5%. I think that itself, that 3% spread, tells you everything you need to know about which bank will win this battle for the spoils of the decimation of the public sector banks, right? And I think that's one of the things, one of the reasons I enjoyed when I was Tej's age. I was a financial analyst because this is just such an enjoyable sector. You can just walk to the high street, meet various banks, and learn so much. Tej, back to you.
You've touched upon this subject in your book of development of the bond market in India. We've been talking about it now for, I think, 2 decades. Do you think that we'll see something like what we've seen in the US, some of the European countries, the bond market finally being developed in this decade? And therefore, we'll see some market share shifting away from the banks as well, and corporates tapping the bond market.
Tej, I wish I could answer your question. We have been talking about it. There's incremental development, but comparing with US, I don't think it's happening there. In fact, regulators have been trying. If you have seen that both SEBI and Reserve Bank of India, through a lot of new rules, they are saying that certain amount needs to be borrowed from the market, not this thing. And one of the reasons why our bank could hide their actual health is because of our bank-led financial system. Now, had they been because the corporations have they borrowed from the market, then no way the default would have come on its own. There no way, because here there is actually the understanding between bank and the corporations. Even if I am a borrower and if I have failed to honor my commitment, Saurabh, you are my banker. You have also have interest. You have skin in the game. So you and me do a sort of understanding that, look, it's a win-win. I'm not paying you, but you are not exposing me, because by exposing me, you end up exposing yourself. And you have to show your bad assets. You have to provide for, and then investors will ditch you, so on and so forth. But had there been a vibrant corporate bond market, and had the corporation gone to that, then they would not have been able to do this. So I wish, because there you can't have that kind of quid pro quo between the issuer and me. I mean, if I am a borrower, I have borrowed money from corporate bond market, and if I fail, then I'm a defaulter. No way I can convince my bond issuer, just no, you forget, we'll manage some way and all. So one of the reasons we got into this trouble and this AQR exposure, because we have not had a vibrant corporate bond market. We have been talking about it past, I don't know how many decades. Things are happening, but I don't think we are anywhere close to even discussion about reaching the height of what the US bond markets have.
So, I think we've taken up hour and 15 minutes of Tamal's time. We'll ask you, Tamal, one more question, and Tej,
Sure.
then let's do a summary for our listeners on what we have learned from Tamal in the last 75 minutes or so. So let me ask him the question, and then I'll hand over to you, Tej, for the summary. Tamal, your favorite books on banking, on finance, the books which you learned. Your craft. You've taught a generation, my generation, Tej's generation, about Indian banking. Now we want to know, what are the books from which you learned about banking, finance, and about the Indian economy and so on?
You will actually change your opinion about me. I'll not remain a wise man or whatever it is, because I honestly I am not a good reader at all. If you ask me, my study is full of books, etc., etc., but do I read them? No. I'm not an avid reader. So it's I actually basically I seek information. Not that I don't read book, not for anything else. It's I'm not a fellow like any new book comes up and I read them, but I read them because I need to join, have conversation on them. In some sense, I read some of the books. Some of the books I read like somebody tells me that, have you read this book? It's pretty interesting, so on and so forth. That's how I read the book. Otherwise, I am primarily an information seeker. So whether it is when in the US Federal Reserve's the real-time meeting happening, I stay awake till midnight to catch up on television channel what happened, what is the FOMC has done. or the next day's morning this thing, and all on the Reserve Bank of India website, and all kind of things. That's what I do. So if you ask me that the book I read and I learn and I want to tell your viewers what should read them, no, I'm not like, there are books like, for instance, I got the idea of having this particular segment on chart is from the book which on the Lehman crisis, Banan K and all three of them have written one paperback, where they have, of course, many more charts than this have that. So like those are the things which because I wanted to read, I picked up that book again, because I somebody told me that the what words can't say, charts can tell that book can, and this book is an example. So that's what I picked up. The US Federal Reserve and Treasury guys, three of them have written this book. Very small. It's a 2-hour read. So like I'm very utility driven. Something helps me. Otherwise, I'm not. And of course, when Viral Acharya's book comes, or Dr. Reddy's book comes, or our immediate former Reserve Bank of India governor's book come, or Rajan's book come, etc., etc., I need to read, because there is a discussions I need to do. But otherwise, I'm not. Gentleman who would be like, for instance, it's a very old book, I think 2012 book. Now somebody told me recently, and I started reading it and I'm enjoying it, and this is the book of Taleb's book of Anti-Fragile. It's a 2012 book. I knew this book. I have it at my home, but I just saw it and all. But then somebody recently picked up certain pages from there, and over a drink, this gentleman, a banker, was telling me, and I found it pretty exciting. And now I just finished reading that book. It's a 2012 book. Now the provocation was, somebody pointed out, and I just and directed me there. So like that, I have read your books because I know you, and so
Very kind of you. So, Samal,
okay,
your book,
so it's
right?
like
Your
that.
book, Pandemonium. This is the
Yeah.
closest we have seen in India to Andrew Ross Sorkin's book, Too Big to Fail. So, Andrew Ross Sorkin wrote this book. I think it's become a movie as well, on Lehman and the unraveling. This is the closest. This is the closest anybody has written in India to Too Big to Fail. And for everybody who's on this call, for your own money, for your deposits, for your future, for your investments, please read it. It's an essential guide to living in modern India. A lot of people have these completely delusional notions that our money is safe, the system is safe, and so on. You might, you and some of you might believe it's gossip to know how credit rating agencies can be induced to do naughty things. Some of you might believe it's gossip to know how promoters can be induced to do naughty things and bankers can be induced to do naughty things. Our submission would be, it's essential information to understand how in every level of our financial system you can compromise actors and put the country's financial interests at stake. So, Tej, I'll hand over to you your summary of what we've learned from Tamal Bandyopadhyay, and I'll wrap up at the end with a quick summary of our Kings of Capital thesis.
Sure. So the most remarkable fact, so we've been talking about 65% market share with public sector banks, 35% with private sector banks. The most remarkable fact from this book was the chart at the end, which showed that over the past couple of years, we've already seen a large shift of market share, not only on the loan book side, but also on the deposit side, with about 80% of incremental deposits, 80% of incremental advances going to the private sector banks. Tamal said that we'll see the large banks becoming larger over the next decade. And over the next decade, we'll also see that the market share shift will accelerate from the public sector banks to the private sector banks. On the comparison that we make to the Western economies, why banks are not flourishing over there versus why we see banks doing so well in India, that is where we got the question on the development of the bond market in India. So like we've been discussing for a long period of time, that's not happened for the past 2-3 decades now. And we discussed that it's unlikely that we'll see the bond market developed at least in this decade. So there's a long way to go for the Indian banking sector, especially the large private sector banks. Thirdly, it is the well-run private sector banks. It is the banks the likes of HDFC Bank, the likes of a Kotak Bank, who have an entrepreneurial culture, who have the culture of doing the right things the right way. These are mostly simple things, but the impact of these simple things are large enough, and they create wealth not only for themselves. The employees not only create wealth for themselves, but also for the shareholders. And that trend, we believe, is likely to continue for some time to come. So a lot of takeaways from this 1 hour session, and these were the 3 key points from
Just to
our side.
quickly tie it together with the Kings of Capital thesis, why did we launch the portfolio 6 months ago? We launched it because our view, and Tamal's book, I think, quantifies that view nicely. Our view is that the PSU banks will unravel. That market share will end up with the private sector banks. There's a great deal of money to be made investing in well-run private sector banks. Hopefully the last 1 hour, all of you watched have got more conviction on that. If you read the book, you'll get more conviction on that. If you read Tamal's book on HDFC Bank, his 2 books on HDFC Bank, he'll give you further conviction on why well-run private sector banks will make a great deal of money in the next 10 years or so. The second reason for launching Kings of Capital was we could see, in fact, we predicted it in our erstwhile avatar, and we could see that naughty things were happening in the NBFC sector. They were doing dodgy things to borrow money. They were cooking their books in some notable cases, some of which are in the public domain. And I guarantee you more of which will come in the public domain in the years to come, as assiduous journalists like Tamal keep sniffing for the next DHFL. We could see the credit rating agencies were being naughty in cahoots with the NBFCs, and we believe, therefore, the NBFC sector too will consolidate in the hands of a few really well-run NBFCs. I think we've seen the beginnings of that with DHFL and ILFS. There's a long way to go. I think there'll be more developments in that NBFC unraveling over the course of this year, and the stronger NBFCs will collect more share. And the third reason for launching Kings of Capital was the RBI is repeatedly highlighting in its website and its Household Finance Committee reports that 95% of India's household wealth is in financial assets. The RBI is repeatedly saying there is no other country on the face of this planet which has 95% of household savings in physical assets. The RBI is repeatedly saying that no other country has 95% of household savings in physical assets, a mere 5% in financial assets. We can see from the RBI data that the situation is changing. Rather than having a mere 5% in financial assets, we're adding to that number. Just to put it in perspective, folks, India's total household assets are around $10 trillion. Nobody has an exact answer, but basis what the RBI has done, it seems that our household savings in totality is around 10 trillion. As per the RBI's estimate of only 5% of that being financial assets, that means we have as a country a mere $500 billion of household financial assets. Jeff Bezos alone has more than $500 billion of $500 billion of financial assets. And therefore, if you read the RBI work, they're saying we will shift to financial assets. As we shift to financial assets, obviously the banks will benefit, the deposit flow Tamal talked about, but the well-run life insurers, general insurers, and asset managers will benefit. So there are 3 different moves afoot: the decimation of PSU banks, the demise of naughty NBFCs, and the rise of financial savings. Kings of Capital tries to capitalize on that, and hopefully you'll join us in that journey. So I'll thank Tamal Bandyopadhyay again. Thank you not just for this great book, but thank you for being a teacher to a whole generation of people like us.
Saurabh, the book I was talking about, this Firefighting by Bernanke, Timothy Geithner, and Henry Paulson.
Fantastic, sir. Thank you very much.
It's a small paper. It's a very short book, paperback on this financial crisis. And I told you the idea of charts. I had this book is one full chapter only on charts. Wow. So I thought that Indian audience may not like so many charts, but the idea I stolen from this book.
Absolutely, and I'm glad you did. It makes your book richer for it. Thank you very much for joining us and enlightening us this evening. And thanks to all of you on a weekday evening for joining us. Wishing everybody the very best for 2021. Thank you. Thanks,
Thank you, Saurabh. Safe and happy 2021.
Thank you.
Bye-bye. Bye.
Thank you.